Good afternoon. My name is Alan McCoy. I'm Director of Startup Support at the University of Maryland's UM Ventures. And I'd like to extend a warm welcome on this very rainy and dreary day to everyone who joined us for the next installment of Startup Fundamentals Workshop Series. Both live webinar audience and those watching recorded version on our Startup UMD YouTube channel. This workshop series is offered by UM Ventures in collaboration with MTech at the Clark School of Engineering and Dingman Center for Entrepreneurship at the Smith School of Business. Everyone in the live session, thank you. Please feel free to submit your questions using the Q&A function at the bottom of your screen. Actually, it might be at the top of some of you, depending on your setup. Just a note that we are recording this session that will be posted on our YouTube channel. So for those of you who wish to remain anonymously, you have an option to submit your question anonymously as well. So today's session will focus on how to divide equity in a startup. And it's a question that all startup founders must address. And not doing it right can have serious implications for startups' ability to attract investors and key hires. And I've seen it ruining startups. I'm pleased to introduce today's speaker, Timothy Jones. Timothy is a serial entrepreneur, investor, and experienced startup mentor. Thank you so much for sharing your time and expertise with us today to discuss this important topic. I'll let you to talk a little bit more about your background. I'm gonna mute my mic and turn off my camera. So the stage is all yours. Again, thank you so much for spending time with us today.
Great, thanks, Ala. Appreciate it. And again, Ala wins the best background award with the sunny background compared to me with just kind of a murky evening somewhere in the Baltic, if I remember correctly.
It looks fantastic.
So again, again, it's an great opportunity to talk with you all today, and I'll say that in many ways, what I want to do is share with you the mistakes I've made, and hopefully people can benefit from my experiences. So again, I'm Tim Jones. I am just a quick background here. I have basically been around the startup ecosystem for far too long. I've been involved in 7 different startups, from early founding CEO, co-founder, etc., or early employee. I've been fortunate enough to be involved with a couple of companies from early stages through the IPO process. I'll talk a little bit at the end about what that's actually like. I've actually worked, one of my big passions is working in university ecosystems, which is why I am very vocal about the University of Maryland ecosystem and the greater areas ecosystem as being a real source of value. I actually am originally from Berkeley, California, so I kind of grew up on a university as a university kid, and if there's anything that I'm really passionate about is spinning research out of major universities and research institutions and turning that into companies and products. I spent a couple of years as a VC, as a card-carrying VC. Actually opened the McLean office of a West Coast VC back during the internet bubble, and saw what that craziness was like. I've also spent actually 2 decades as a limited partner in different VC funds, and have the perspective of being not just an investor, but the limited partner in investment firms, and what that's like, because there's a life cycle there that I think entrepreneurs need to be aware of. It affects fundraising, it affects liquidity, it affects your relationships with professional institutional investors. I've looked at least 1,000 companies in evaluation mode, also as a SBIR panel reviewer for the National Science Foundation and for other agencies. So I've looked at tons of companies, and I like to say at the end of the day, I have either seen or myself executed and committed tons of mistakes. And again, that is really the topic, really kind of the subcurrent of today's conversation is, don't make mistakes that others have already made, and learn from those mistakes to make your path a little bit easier. So I'd like to start off with a quote that was something was said to me by someone that I took as a mentor the first time I actually raised venture capital as an entrepreneur. And I will fully admit that I didn't really deeply appreciate the wisdom in this phrase. This is a quote from Richard Brock, who most people won't know. He was the founder of Brock Control Systems, which was really one of the first sales information software packages. So today, Salesforce is the dominant player in that space, but once upon a time in the 80s and the 90s, it was a really fragmented market. And Richard Brock organically built a company called Brock Control Systems, which was one of the first of these Salesforce automation CRM tools. And in the 90s, I went to him when I actually received term sheets from venture firms and asked him for his advice, having been an experienced entrepreneur. And he shared with me this bit of wisdom, that is, when you look at equity and you look at ownership as a founder, it's better to own a slice of a watermelon than the whole of a grape. It's better to own a small slice of something that ultimately is very valuable than to own all of something that doesn't become very valuable. And the corollary to that, I would say, is that if you focus on ownership over value, you end up creating neither. So if there's any one thing, there'll be two things I want you to remember from today's presentation. First and foremost is this: it's better to own a slice of a watermelon than the whole of a grape. Focus on having a small piece of something that ultimately becomes very valuable. And the second part will be around controlling the vesting process. So a few things I learned along the way, and I'm going to basically go through each of these topics and try to make sure we leave ourselves time for any questions. So one of the first things to really understand about equity is that equity actually belongs to the role or to the job that's in the organization. It doesn't belong to a person. And it's almost like what people talk about nature, right? You don't really own the land, you're just the steward of the land. And when you take the mentality that equity really belongs to a job, then I think you can see much more clearly how to divide equity up and how to allocate equity over the life cycle of a company versus the canonical starter myth where a company started and people sit around and divide up the company on a napkin and then they go forward and create value. When you really, really deeply understand that equity belongs to a role, it sets you up, belongs to the role, not to individual personalities. It sets you up for growth in a much more healthy way. And I'll get into some of the detail on that. The second thing that I actually wanted you to remember, other than the watermelon grape parable, is that everyone has to vest. Everyone has to have a vesting schedule where they don't own the equity outright, or rather that they are basically getting the equity doled out over periods of time as they perform in the company. This is critical. And I will openly admit, I knew this, I have learned this, and I still, in one particular venture, made this mistake of not vesting everyone over time. And I'll get to how this actually impacts the growth of a company. Another important point to realize is that I was joking with a serial entrepreneur, a very successful entrepreneur, who's a personal friend a while back. And his belief is the same as mine, is that it takes 7 years to build a company, or at least to get to the point where you know whether or not you have a viable company. So even though you may read on the newspaper that, or TechCrunch or whatever, that so-and-so started a company and 2 years later they went public, which is what happened a lot during the internet bubble, and to a lesser extent happened during the social media bubble. On average, when you step back and look at the building of a company from initial idea all the way through to quote unquote success, it's about a decade. It's 7 to 10 years, and 7 years is the number that I've arrived at. That's important for a couple of reasons. First and foremost, pacing. You have to understand that this is really a marathon, not a sprint. But also when it comes to equity, you've got to have your equity allocation set up so that you can sustain people over the full life of the company, and you don't have vesting that basically disincentivizes people to stay for the full journey. Another critical thing to understand is that, particularly if you raise money from institutional investors and you raise money in successive rounds, there's essentially an 80-20 rule here, where by the time you get through that 7 years, by the time you get to liquidity, whether that be an acquisition, a self-sustaining business, or an IPO, roughly 80% of it, 65 to 80% of the company is going to be owned by outside investors. Again, if you are raising outside capital as a requirement to run the company, and 20% or thereabouts will be owned by the insiders, including the founders. And again, this is one of these things that it's important to get past the mythology of startups that you see on the pages of the tech press. It's very rare that you'll have a founder with 50% of the company at an IPO. That is extremely rare. And when that happens, it's because there's been an irrational slash rare event in the financing history of the company. That might be an anchor customer that pays all upfront in cash and gives them years worth of capital. It might be because for whatever reason, it's an extremely low capital sort of company. But just in your mind, if you are looking at a venture that is going to be dependent upon institutional venture capital, and particularly if it's going to need to raise multiple rounds of venture capital, so biotech, hard tech, etc., you should have in your mind that that founders and key employees will own roughly 20% of the company by the time you get to liquidity. Again, I'm going to go through all these in a little bit further detail, but I want to explain them a little bit more before I get in. It is important when you are setting up your company that you actually think about an equity pool for future hires, and that isn't an afterthought. And a good investor will actually require you to do so before first institutional financing. But again, it helps support this thesis that essentially equity belongs to the role, not to a person. So if you assume that you're going to need equity in order to recruit people into important roles over the life of the company, you're going to set that equity aside in your capitalization table so that you can recruit people into those roles. And so again, it's not just a mechanic, it's also part of a mentality. The rule of 10 alludes to a way to divide up equity so that you don't run out of equity between financing rounds, which is actually a bad thing. It's essentially just as bad as running out of cash. Another thing you want to look at doing is basically aligning all your incentives to long-term value of the company. So as much as possible, getting the incentives of the organization set up so that people want the equity in the organization because they think that that's going to be the asset of greatest value, that they want equity versus cash. And using equity rewards as a way to actually motivate people is very, very important in the most valuable companies that I've seen. Now, a lot of this I'm discussed so far, and we'll get into greater details around what happens on the quote unquote on the way up. Let's say on the way out, when you start talking about liquidity. It's really important to think about tax efficiency. Very often people will launch a company and not think about, well, if I'm successful, what happens then? And there are some mechanisms that you can utilize as a founder or as an early investor to maximize the tax efficiency of being involved in illiquid startups where you're going to be holding the equity for a long period of time. And the last point I'll make is that a bit of I think also a cultural, but also a experiential point is that the IPO is, first of all, it's a financing event. It's actually not a liquidity event, despite, again, what the press and PD and movies will tell you. But it's actually the beginning of the real value creation of a lot of companies. And so I think in the startup community, there's very often this belief that you start this thing, you labor away for years, you get to the IPO, and then magic happens. In reality, you're actually kind of at the beginning of the next phase of the life of a company. I can tell you anecdotally what that's like. So first of all, equity belongs to role, not to the person. Classic mistake made in starting a company is assigning equity to people based on their join date. So the earlier you join, the more of the company you get. And that does a few things that really, really impair the growth of the company. First of all, you end up not allocating enough equity for the people who are going to have the biggest impact on the overall life of the company. So those who are there first, yes, they take a lot of risk. But the risk when it's 4 people around the table versus the risk when it's 2,000 people trying to go public, very, very different levels of risk and very different levels of responsibility and span of control. So when you separate equity from a person, individual persons, and think about equity in terms of what roles you will need in order to make a company successful, you get yourself away from this join date based ownership of the company. So a better approach I've seen work is, and this is where working with good advisors, outside tax advisors, outside attorneys, and using services like Carta, for example, to help you track the capitalization chart, is to actually look at the amount of equity you're going to need over the life of the company. Again, it's an estimate, it's a pro forma, like a financial model. And think about the equity you're going to need at different stages to recruit different types of personalities. As an example, the first person to write, and again, my bias will be software, but the first person to write the first iteration of a software product, that technical founder, is not necessarily the CTO and not necessarily the VP of engineering that you're going to need in order to make that product fully scalable to thousands, maybe millions of users. So a better approach is to think about the equity needed to motivate an early technical founder, the equity that would be needed to recruit in a CTO, excuse me, that can actually build a real architectural roadmap, and the equity needed to bring on board a VP of engineering who could run an engineering group with systems and GitHub repositories, et cetera. So when you plan the equity out as a life cycle, over the life cycle of a company, I think you have a much more appropriate utilization of that equity. Culturally, this mentality of equity is never really owned, it's kind of rented. And the whole idea here is that the longer you're with an organization, the longer your rental period and the greater the reward to you as an individual contributor. And so going to that example of an early technical founder, that early technical founder is able to grow with the company, grow in responsibility from technical founder to technical manager to director, et cetera. They should be able to get successive equity grants that give them greater and greater longer term stake in the company. So that's the way you combine the role-based equity allocation with the growth of individuals as they might mature in the life of a company. You don't have to give it all to them up front. You can basically dole it out over time as people grow with the responsibility. Very often when people think about equity, they think about fairness. And this is why I use the example of the canonical 4 founders who each give themselves a quarter of the company. Fairness isn't a normal distribution. Fairness isn't an equal distribution. Fairness should be viewed in the eyes of what's good for the company and what's best for key stakeholders and shareholders in the company. And the underlying theme here is you want to provide maximum equity to the people who are driving the maximum value. And if you take that approach versus it's Animal Farm, all animals are equal, that sets you up for I think a smoother path. So I mentioned the second thing you want to remember: everyone vests. Everyone vests in their stock grants and their option packages over time. Everyone, founders, advisors, everybody. The general standard investing is a 4-year vesting schedule with a 1-year cliff. So basically you're vesting 1/48 a month over the life of the grant, of a 4-year grant. But that first 12 months is basically embargoed until you get through your cliff period, and then you get all of that up front, and then you continue to vest 1/48 over time. My point of view, given that 7-year horizon of actually really building a company, a 5-year vesting schedule is better. It's actually more applicable to the actual time frame in which you're going to have to be in the trenches building a company anyway. And the idea of a longer cliff than 1 year, 18-month, 2-year cliff, from my point of view, is actually better in terms of preserving equity in the company and preserving the control of equity in the company. So why vesting? Things happen. People start a company and life happens. People move, spouse decides they want to do something different. There's a change in life circumstance. There's a reduction in momentum. People run out of the talent to do what's necessary at the next step in the life of a company. And when that happens, people should be able to leave and go do something else, but do so in a way that doesn't impair the company by them taking a large amount of equity with them. So essentially, people should be able to leave with what they've accrued through performance and through their work, not leave with a huge chunk of equity that is acquired when they initially put their name on a napkin, a couple of years earlier. This is extremely important because the equity that is quote unquote owned or is under the control of people who have left an organization distorts the cap table. And if you have key people that have left a company and have large amounts of equity, it makes it very hard to finance the company. It makes it hard to recruit people in because you've essentially diluted a lot of the equity that would go into the stock pool. So even an employee with only 10% ownership or 10% of the equity basis of the company leaving early with that 10% can actually be pretty detrimental. It creates this weird air pocket in your capitalization chart, and you find yourself having to work around that. Also, the point you get into is that whenever there's a next financing, there's an investor rights agreement that those early employees have to agree to or sign off on. If you find yourself chasing a bunch of people that have equity because they've left early and they weren't vested, or rather they left early and they weren't really vesting in that equity. They just took it all and left. You end up spending an inordinate amount of time trying to track people down in order to get their agreement to another financing of the company. So second thing, first thing to learn, better to own a slice of a watermelon rather than the whole of a grape. Second thing is that everyone vests. And I have made this mistake. Going in, knowing it, and I have still made this mistake. And this is an extremely painful one because it does affect a lot of the decision-making downstream in the company. As mentioned earlier, it takes 7 years to get anywhere. It might take you 7 years to know that it's not working. Even if you have, an operating business and customers. That's happened to me where I've had an operating business with customers and revenue and patents, and we ultimately had to sell it because it took us that long to realize it wasn't really working. It wasn't going to get to the level we wanted it to. It may take you 7 years to know that it actually is working. There are plenty of examples of companies that toiled in obscurity for long periods of time, and then a spark happened, and then they took off. And a great example of that is NVIDIA. NVIDIA, the GPU company, NVIDIA went public. The company was actually founded in 93, if I remember correctly, went public in 99. But between 99 and 2012, basically kind of toiled in obscurity as a publicly traded company, but not very well known. And it was when a Stanford professor realized that he could use the GPUs to do machine learning and AI. And the GPUs were, again, initially designed for games, but that he could use those particular semiconductors for machine learning and AI, that NVIDIA took off. So there was a really, really long period of time from essentially 1993 until 2012, when with a viable company that was in business, there was no real takeoff point. So I say this because it is really important that people are emotionally ready, and that their spouses and families, before you do a startup, are emotionally ready for the long haul it is. So what that means from an equity perspective is that you actually have to, even with a vesting schedule, for example, a 5-year vesting schedule that I mentioned earlier, you need to make sure that you have continued incentives to keep people involved, even if they complete full vesting of their initial package, which means you add additional packages, which means you actually have to have equity in that pool to give additional grants. So very often when a company is set up, people get the default 4-year vesting schedule and think they're going to get it all done in 4 years. And if you don't think about the real life cycle and the timeline to build a company, you could run into a scenario where you don't really have anything to offer the early employees, and it's actually a logical decision for them to leave and go do something else, and you lose not only that talent, but you also lose a lot of that momentum and that brain power. So think of this as a much longer run than a 4-year vesting schedule, and think about also allocating equity for additional grants to keep people engaged. I've talked a little bit about this idea that at the end of the day, there's an 80-20 rule in ownership. If you're going to raise institutional venture capital in capital intensive industries or sectors, so energy, hard tech, biotech, semiconductors, where you're going to raise a seed round, maybe a series A through D round, maybe E or F or G round even. Expect that when it is all said and done, if you're standing at the New York Stock Exchange ringing the virtual bell, that 80% of the company is going to be under the control of investors, and only 20% will be under the control of management and key employees, including the founders. If you raise less money, that ratio improves. A good example from my own experience is Sybase versus Oracle. I started my career actually at Oracle, but after they had already gone public, and subsequently was at Sybase, another enterprise database company. And the difference in IPO in wealth creation at the IPOs was pretty drastic between the two. Oracle never raised venture capital. They raised some angel money, but then got a major contract with different intelligence agencies. And that was the basis of their business. So they never went through your traditional venture capital, multiple rounds of fundraising. Sybase raised money from Hambrecht and Quist and a number of, at that time, flagship Silicon Valley venture investors. I was there a year after Oracle went public, putting a date on myself. But when Oracle went public, over 100 people became millionaires. When Sybase went public, I remember being in the room and counting them, and there were 7. And again, this difference is based upon the amount of money raised and the timeline for money being raised. But it's very important to go into this open-eyed about if you do need institutional capital and multiple rounds of venture capital, the level of wealth creation between a venture capital funded company versus an organically funded company. So what this means is when you get to that quote unquote magic moment where whether it be IPO or acquisition, your founders and your C-level key hires may only have 2% percentage points of the company, maybe up to 5, but they're not going to have 10%, 20%, 30%, things that you'll read occasionally on TechCrunch. Your key VPs will have 0.5%, maybe to 1.5%. Your directors 0.25% to 0.5%, and so on and so forth. So when you hear these stories of huge amounts of ownership, that is really the exception, not the rule, particularly if you're raising institutional capital. So a couple of quick graphics to give you the visual. So I think the canonical founder story that's in people's head when they think about Silicon Valley is 4 people sitting around a table and they have the big idea and they put the napkin out and everyone signs their name and they each own 25% of the company. And in their heads, they think they own that 25%. Again, they think they're owning it. They're not realizing they're actually renting it for the period of time that they're in the company. In reality, if that founding team is going to need to raise venture capital in a seed and then Series A round, this is really what the ownership is going to look like in the coming out of the Series A round. Each founder will have 12% or less. The venture capital investors and the venture capital investors alone will take 35% of the company, maybe 40% of the company. And as market conditions get worse, that percentage goes up because valuations come down. Seed investors may or may not be part of that A round or not if they are investing on a pro rata basis. And the stock pool will be created. Some investors will demand it. Smart ones will advise it, because if there's a need to recruit in additional people, that equity doesn't come from what the venture investors own. It's going to come from the founders. So you might as well set the stock pool up immediately. So that's what your Series A looks like. Now imagine you're going to go through multiple rounds of financing, B through D, maybe even EFG rounds, which puts you in a position where when you get to liquidity, it looks a little bit more like this. And this is a generous graphic where those 4 key founders have roughly 4% each. In reality, most companies, it's about half of that. And the employees, that's everybody else, C-level hires, VPs that have brought in along the way, even early employees that were more junior employees are a part of that other 4%. And the rest are VCs, institutional investors, who basically finance the company along the way. This is much more like what reality is. So again, the equity is rented, not owned. And if you do need to raise additional capital, it's really important to not have this thesis that you're going to basically try to hold on to the grape versus have a slice of the watermelon, which is really what this is in many ways illustrates the Richard Brock's wisdom from the first page. I mentioned the stock pool. That initial 10 to 15% of equity at your first financing in the pool it should be carved out up front. It's important to carve it out for 2 reasons. One, it creates a much more frictionless financing for your first round of financing. It also sets the mentality that you are using that equity in order to bring people into the company who either weren't there at the beginning or would only join with the equity incentive. It allows you to recruit in more senior people than even the founders, who enable the company to scale. If it's possible, it's a good idea to try to replenish the pool with every round of financing. So very often when you do a round of financing, new shares are created. It's a good idea to reach which you can is to make the pool evergreen. It's hard to do because the equity has to come from somewhere. It generally comes from the founders. So that 25% that people have in their heads that becomes 12% that ultimately ends up in 4%, that equity that ends up going to the pool comes from the founders. And the founders need to be mentally ready to essentially continue to take equity that they think they own, but put it into the pool so that they can recruit additional people. A good way I like to look at this is outside capital is the fuel that allows you to actually fund the company, to pay salaries, take care of infrastructure, etc. The internal equity is the fuel that enables you to incentivize people to join and to build the venture. So you need both types of fuel, the outside fuel being cash, but the inside fuel being equity. Just from a practicality standpoint, the way you can also help replenish the pool is that you have repurchase options and clawback options, investing agreements to help replenish it. So even if someone is vested in their stock and they decide to leave, at least there's an option to potentially repurchase their shares to put those back into the pool. Many people will leave a company, be vested, But if the company offers to buy the options back, they'll take the cash. And the classic example of that is I blanked on the gentleman's name. I think it's Ron Wayne, who was the third founder of Apple, who sold all of his stock for I think $400 odd, and it's worth on the order of I think 100 billion had he held on to it. So for every one of those stories where someone regrets selling, there are many others where people just simply will take the cash and they'll take the sure thing today. So having those legal options built in is important for helping replenish your stock pool. Another good way to run out of equity is what's referred to as the rule of 10. And it's a back of the envelope assessment, back of the envelope algorithm where at every level of the company, the level of stock that is assigned is 1/10 that of the next highest level. So if the CEO has 1 million shares, the VPs get 100,000 shares, directors get 10,000, and so on and so forth. This is really more of a quick and dirty way of building a cap chart, but it enables you to build a cap chart where you leave a buffer so you don't run out of equity. And again, it is really important to not run out of equity before you raise the next round of financing where new shares are created, because venture investors will not want that equity to come from them. And you don't want to be in a position where you're having to go back to key employees and founders and getting them to essentially dilute without new money coming in so that you have equity to recruit people that you need in order to get that next round of equity. So it becomes this paradox. So just as it's important to never run out of cash in a startup, it's important to never run out of equity, distributable shares that you could use to recruit people. The best companies I've seen have aligned the incentives with long-term growth of the company, meaning they've aligned it with the equity, not with cash. And equity can be used to drive very high levels of performance beyond which that are not considered to be normal. And I think it's really important in setting up a company is you also, in addition to the actual capitalization of the company, that you create incentives so that if people stretch, that they can be rewarded for that stretch, and they are rewarded in equity in the venture. So they are incentivized to do things that make the overall venture more valuable. Again, getting to that idea of building the watermelon and not the grape. So a developer that is, over the moon productive, the proverbial developer that's better than 10 times, more than 10 times better than other developers, that person should be able to get performance-based packages for their creativity or their productivity, and that those packages are equity-based so that they are incentivized to continue to be productive and to continue to create, and that other people see that those incentives are allocated for people who are productive. Same thing with salespeople who basically bring in that elephant deal early in the life of the company that can reduce the necessity to go out and raise outside venture capital. This is one of the things that Oracle did extremely well, that Larry Ellison did extremely well, was incentivize salespeople, not just with cash commissions, but with stock. And it was relatively unheard of at the time, salespeople really being concerned about stock options and not just cash comp. But that incentivized people to go off and close monster deals such that Oracle did not have to go and raise venture capital to grow. And that led to overall a much more valuable enterprise for everyone involved. These incentives should also be very visible. And speaking of Larry Ellison, one of his famous quotes, I remember him saying, is he wanted developers driving Ferraris. And the thesis here is he wanted to have some of the most valuable people in a software company, being software developers, being visibly successful with their option grants, such that people would see that visible success, in this case, the canonical Silicon Valley Ferrari from Ferrari of Los Gatos, and would aspire to that same level of performance. So making these, so whereas cash is, comes in, gets taxed, giving people options and equity, greater equity in the organization, and making that grant very public, and also making it clear that certain people can be rewarded disproportionately for their productivity, goes a long way to getting the incentives around building a more valuable enterprise, building that watermelon of value. It creates a dynamic where people want more ownership. Even latecomers or late joiners to a venture will want more ownership in the venture, just as much as the founders want ownership in a venture. And that's a really healthy environment for a company where people want to own more of the business where they go every day. One of the best things, again, using the Oracle example, because in many ways they they did a lot of things right. Um, Later joining employees, non-founding employees, and non-founding employees that sometimes were in critical but not necessarily visible roles will often get equity incentives. So, for example, you'd have administrative assistants and secretaries at Oracle that would get stock option packages granted. And there are a number of those 100 millionaires when Oracle went public that were actually administrative assistants, not developers. Because of the fact that at critical points of time, they established a process or helped lead the company or manage something important for the company, and reward for that leadership in that area, they were given equity-based incentives, just as much as a software developer would be. So these are all things, again, I mentioned that are the parts of what happens as you're growing the organization. What happens when you start talking about liquidity? What is very often overlooked is tax efficiency, the tax efficiency of being in a startup. And you see this become important in periods in the market like what we're seeing right now, where there's a lot of discussion about whether or not one should exercise their options based upon the option price and the actual market price. The one takeaway I think around this topic, I think it's important to understand, is that the long-term capital gain shot clock is your friend. So holding on to your options or your vested options for as long a period as possible, 18 months, 24 months plus, so that you can shift from short-term capital gain to long-term capital gain, is critically important. And there are a variety of different vehicles for doing so, but I always advocate for someone in a startup thinking about equity in a startup is to buy, or rather exercise their option, pay the option price as early as you can when the valuation is as low as is possible, and forget about it. Pay whatever tax you need to pay at that point in time based upon the then valuation of the stock, and set it aside and let that shot clock. It's like what Warren Buffett says about compounding. Let that shot clock work in your behalf, because the actual take-home difference, if you sell stock that has a long-term capital gain, incentive stock options, ISOs, that has a long-term capital gain treatment versus an ordinary income treatment, can be night and day different. There's also a little tax carve out in the tax code called the 83B election. And this is for early key employees and founders. That again enables you to actually purchase stock up front, and then get the tax treatment, pay the tax basis at that period of time. Now, when a company does allow key people to do an 83B election, that sets them up for great tax efficiency. The advice I will give is that you still want to have a vesting schedule assigned to that and a repurchase agreement assigned to that. So if someone does an 83B election, they're still vesting over a 4-year or 5-year period. If everything works out fine and they stay with the company, they get the benefit of the early tax election. But if they leave, the organization should get the right to repurchase those shares at their previous basis. And then there's also a more recent tax treatment called the qualifying small business stock election, which is under Section 1202 of the tax code, which basically creates essentially a $10 million tax-free, or basically a $10 million tax-free windfall in a company, provided that you exercise the election early in the life of the company. So this is something that has to be done at the company level, or at the investor level. And it is for companies that have sub $50 million market capitalizations at funding. So you could have a seed level company that takes this qualifying small business stock election, and then all of the shareholders in that company, essentially, assuming it goes on to be wildly successful, the first $10 million of the return is essentially tax free, provided it's rolled over into another qualifying small business investment or venture. So this is a way you can set up essentially an evergreen outcome that is essentially tax free. And that's something, again, it's important to talk to individual tax advisors as well as company tax advisors. But why I mention all of this is that people get into startups very often. They're thinking of building the company and one day, we'll be rich, but you've got to think about the tax efficiency, because if you don't plan the taxability correctly, you could end up in a scenario where you get a windfall, but it gets taxed as if it's ordinary income. And then when you divide the number of years you may have spent working at it, you may have been better off just kind of staying at your day job. So this is an important thing to learn. And this is a last of two slides, and then it gives us some time for questions. Um, I think we built a mythology in the startup community or in the tech community about the IPO as this, you know, opening of the gates of Valhalla moment, and everything is great, and stuff falls from the sky. And having kind of gone through this actually two times, I got to admit it's kind of anticlimactic. Um, it's companies will throw their party, champagne gets opened, but the behavior of the company shifts. I like to say everyone becomes a stock analyst. So after the IPO party, you go walk around the halls, and everyone's got like a stock trading application up on their screen because they're watching the stock price. Another little oft spoken about issue is that if you're an insider in a company that goes public, you're bound by an SEC Rule 144, which basically has a 6-month lockup period. So you actually can't sell. I mean, there are more vehicles now for selling in secondary markets, but when that company goes public, you are prohibited from selling as an insider for 6 months, 180 days. If you are an insider of significant ownership percentage, then you actually have specific lockup periods and selling windows, and which means you have to have professional advice, financial advice, and you can only sell through very specific windows of time. So the IPO, I like to say, is in many ways, it's more of a financing event than a liquidity event. What all the IPO means is that you're now able to go and raise money on the public markets at a lower cost of capital than raising money from venture capitalists. You still have to build the company. Now you have two things going on. One is you have this quarterly shot clock where you have to report to Wall Street. You also have what I refer to here as the little old lady in Topeka, Kansas with one share who stands up at the shareholders meeting and has a bone to pick, and you've got to now satisfy those public shareholders, the proverbial widows and orphans. You actually have a fiduciary responsibility now to a much larger ecosystem of people. And it takes a lot of overhead. It's a lot of energy in being a publicly traded company, which is why very often you see people loving to go private again after they've been public. But one of the big things I've learned, and a big pro tip here, is that in really good companies, high quality companies, more wealth is created after the IPO than before. So examples, Google, Amazon. Google priced at $85 a share, pre-split, and I think it's up 50x since when it went public. And so I think the mentality that's being created in the startup mythology is that the IPO is the end, when in fact, I would argue the IPO is the beginning. If it's a really high quality company, the IPO is the beginning of the real long-term wealth creation. And if you are thinking about being an entrepreneur, I like to say you always want to ask the question, first of all, you want to build for the truly long term. A lot of people dance around that, but for me, truly long term might mean decades. And you have to ask yourself, do you want to own equity when it finally becomes yours, fully vested? Do you want to own equity in the venture you are proposing 2 decades from now? If the answer is no, then that could be a good thing to figure out. You may have saved yourself years of your life when you realize you don't really want to own it. If it were a stock, you'd want to maybe get some money out of it, but you don't want to own it long term. But if you find something you really do want to own 10, 20, 30 years down the road, pass on to your kids, then that's potentially a high value venture that's really worth the effort and the sacrifice of being an entrepreneur, because it's going to be a long road, no matter what. So a few resources, and then I will stop talking and give us some time for questions. A couple books by a gentleman by the name of John Nesham, I think, are really valuable when you start thinking about equity division. So High Tech Startup and Engineering Your Startup are two great references. They're about 20 odd years old, so kind of written before and after the internet bubble, but I think really, really relevant when you get to the granular mechanics of building a capitalization chart, the importance of different advisors, how to think about equity for the role versus the job. So I highly recommend John Nesham's works for being very methodical about building your company. Another good read is Family Fortunes by Bill Bonner. And why this is valuable is when you think about that long-term ownership. What Bill Bonner discusses is more so family-owned companies and privately held companies where there isn't an incentive to go public. And what's really important, I think, here for an entrepreneur is, again, asking yourself that question: do I want to own this for years, maybe decades? And thinking of things in those terms. Essentially only start a company whose stock you would never want to sell. And if you think about that, it may affect the choice of what you would want to do. You may see something that you think is very speculative, but if you really ask yourself the hard question, do you ever want to sell that stock? And the answer is yes. You want to get out before the market closes, crypto, for example. You may want to reconsider how it might be something you're better off buying an ETF in or being an angel investor, but not basically dedicating your money, but also your time and your life to. And the last reference there is Early Exits by Basil Peters, who I've met with multiple times. Basil's a Canadian entrepreneur who is really good at charting out the life cycle of exits. And specifically when it comes to software and internet companies, very often it's an exit may happen sooner rather than later. It may not be 7 years, it may be 18 to 36 months. And there's a certain type of company that actually is best in those early exit windows, not in the longer exit windows. And it's an alternative view to the long-term hold philosophy, but I think it's worth a good read to understand a different way of thinking about things. So with that, I am through. Give us a little bit more time. Here's how you can reach me. Feel free to reach out if you have questions, or as always, I like to say, I want people to benefit from mistakes I've made. And that's about it for me. I will stop sharing, and Ala, I guess we'll go to questions.
Yes, thank you so much. This has been incredibly informative for me, and I'm sure for many. We have a few questions, and I have a few questions of my own as well. Why don't we start with questions from the audience? So we have two. First is, how do you manage expectations for early participants who think they deserve more regardless of their level of responsibility? For example, a sales rep that's steadfast to becoming the future VP of sales uses this as an excuse to take on more equity.
Yeah, so this is why I said, first of all, why I think those references, the Nesham references, are really important, because you do want to engineer your startup. So you want to think of it like you want to build an architecture for your startup. And in that architecture, you would have a VP of sales slot already designed, and then you're going to have an early head of sales slot. And those are not necessarily the same people. So I think when you sit down with that person who is your first sales lead, that's the conversation to have, is to say, yeah, we've got this architected. You may grow into that person, but you're not that person today. So we need to allocate equity to recruit that person in at some point in time. And the reality is, unless you may need a person that has run a global sales force, for your solution. And if the person who's across the table from you has not done that before, then they're not that person. And so separating the equity from the person and make it based on the role. And that's why if you take that approach of engineering your startup, essentially taking your stock pool and allocating equity to jobs, you can then sit across from someone and say, look, your job is here. Here's the amount of equity that's basically allocated to that job. This bigger job is here. You may over time grow into that bigger job through successive grants, but right now those are two separate jobs. And to me, it's a bit of a smell test. If someone will only join a startup if they get 50% of the company, and they don't understand the rationale for actually engineering out the equity pool so you actually have a successful company, they're probably the wrong person. And you probably have dodged a bullet really early on. This is what I refer to as the smoking napkins, the napkin syndrome, where right before a company goes public, all of a sudden someone comes running up to the underwriting team, and they've got the napkin, and the napkin has, Uncle Buddy owns 50% of Newco, signed and dated, with generally like a mustard stain or something on the napkin, and it blows up the entire underwriting process because there's a theoretical commitment for half of the equity to someone who isn't there. So you've got to eliminate these side deals and get clarity, both emotional and intellectual clarity, on the equity that goes with the roles early. And the right people will buy into that. If you I have people that just reject that out of hand and don't understand that, they're not, the person who writes that first line of code isn't necessarily a VP of engineering. They may become someday, but today they're not. And if they do become that person, they'll get that amount of equity allocated to them in their grants. But today, those two are separate. If you can't find people that understand that that's the methodical way to build a company, then those are not the right people to be on a 7+ year journey with.
And to kind of to add to that question, we often have university researchers, professors, faculty members forming companies either with the postdocs or with outside individuals. And typically, the university researcher contributes IP and expertise, but they don't take an active fiduciary role in a company other than that. What type of equity expectations should they have in that view? Because usually they think that they need to own a larger portion of the company because they bring in all of the research and all of the IP that's the basis for the company formation. So how do you view the past sort of contribution of like income in IP and brain trust and such?
Yeah. So generally, if it's a university spin out, at the end of the day, the owner of the IP is the university, right? So I think very often a lot of PIs leap to the assumption that it is their research. Well, no, it's actually been the university's research. In many cases, the university may have received federal funding to do the research. So the actual chain of custody of where the money comes from is generally not with the PI. It goes much further back. The way I look at a lot of scientific PIs is that they very often will come in as, well, again, it depends upon the degree of involvement. There are some PIs who are deeply involved. In a previous presentation, I talked about Dr. Bob Langer, who is extremely involved with the companies that he has spun out of MIT. So even though he is multitasking across multiple companies, he's involved. He's on the board. He's in board meetings. He's providing ongoing scientific support for the productization or the commercialization of the IP. So that type of person comes in as a founder or as a C-level person, and they actually stay over the course of their vesting schedule pretty deeply involved. And so they would look, for the most part, like any other employee. Now, they're not necessarily drawing a salary, so that's the difference, is that researcher may be vesting on the capitalization chart, but they're not pulling cash from the company in a salary. And that's kind of a compromise. You get your equity, provided you continue to contribute, but you don't get cash because you've got your day job at the university. There are other cases where the PI is deeply involved for the first couple of years, and then they're off doing something else. And that's why vesting is important, because you want to be able to say to you essentially want to create almost a consulting agreement for a scientific PI or researcher, where their vesting is dependent upon their continued involvement. If they, for whatever reason, are no longer involved, it could be change of institution, change of life, that's fine. Their vesting stops. They have what is vested already under their belt, but the rest goes back into the pool, and everything's fine. So there is a continuum with which you can treat a scientific researcher or PI that contributes to the company. And there are cases clearly where people take a leave of absence and they go in 100%. So they're not only vesting, but they're also gaining a salary because they're the CTO or chief research officer, et cetera. So there's a continuum, but I do think there needs to be this, as another mentor of mine said with respect to people vesting who want to be detached, to use the phrase, if you ain't here, you ain't here. Meaning, if you're not actively involved with the company, you're not vesting. You're not going to participate in that creation. So if a research PI says, yep, I want to contribute and I'll be there nights and weekends, great, you continue to vest. If it's, hey, it was my lab, my graduate students, I want to own a big chunk of it, and I'll see you guys at the IPO. No, that's there may be some limited amount of equity that gets allocated to that person, but they should not, from a fairness being impact perspective, should not have the same degree of ownership as someone who is there for the next 7 years, 80 hours a week.
Thank you. That was incredibly valuable. And I'm going to reiterate is that vesting for founders is what Tim recommends to also overcome some of those issues.
Vesting for everybody.
Everybody.
I mean, yes, your advisors. You have advisors and board members that will join. Again, same sort of thing. You may have people that decide they want to be drive-by advisors. They want to have their name associated with a cool company and get some stock, and then they never show up. So everybody vests. I'm going to spank my hand again because it's a lesson that everyone has to. You have to reiterate. Founders have to vest. They have to vest themselves. Everyone vests over the life of the company, over the life of their equity grant.
Yeah, thank you. Do you have time for another question?
Yeah, sure.
Okay, thank you. So, next question is, what are your thoughts on companies using employee equity swap programs to boost capital efficiency right before a new series round?
I'll give you my bias. The secondary market in, I'm old enough to remember when it was basically impossible to move equity around or to do certain types of equity for cash exchanges in a company. You got what you got when you signed up, and it was kind of hard to move things around. I will say, I think there are a couple of parts of this. You never want to give something and then take it away. So when I look at this concept of allocations and of grant packages, you always want to show people if you stay and perform and do these things, all this can be yours, and not change the rules midstream. If you design your cap chart so that there's enough of a buffer, you shouldn't have to do too much engineering in order to either recruit new people in or to have some incentives, greater incentives for people. I understand that there's a secondary market that exists and that people want the potential to basically take some money off the table, particularly when you're in later stages. There's a certain degree of the mentality I take there is when you look at the secondary market is, it makes sense if it enables you to be greedy and not stupid. And by that, I mean, if being able to sell stock into a secondary market or to sell to some other party enables someone to put a little bit of cash in the bank so that they basically, they stock away their kids' college fund or create a greater buffer, and allows them to now be quote unquote greedy to try to create that watermelon, and keeps them from being stupid, as in, signing away all their stock for $400, like the co-founder of Apple. I'm all for that, right? So if there's the use of a secondary market to let off a little steam, to be able to go to one spouse and say, look, this thing isn't totally crazy. I was able to buy a new car or put some money in the bank by selling some stock in the secondary market. I'm all for those sorts of things. I just think one has to be very careful about intra-company swaps going on with the cap chart, particularly before a financing. As an investor, you look at that stuff and you begin to try to figure out what it is. Someone try to create like an internal swaps market here versus being focused externally on making all of the equity valuable for everyone. So I don't know if it fully answered the question. I have a perception as an insider, but I think the investor perspective, thinking of how an investor would look at that, is also really valuable. Yep. I think you're on mute. Sorry.
Yeah, thank you so much. This has been incredibly useful, and very much on point for. And I see in the audience we have a number of faculty researchers who are considering startups. So this has been, I'm hoping that's been very helpful for them. And now there were follow-up questions on the tax issues, and I'm thinking that we will invite a tax accountant to fully explore those, because it's just, we don't have enough time to do this in one presentation.
Pay for a good tax person. Pay for a professional who understands early stage startup equity. It is worth the money.
Yes.
Don't go to H&R Block for this type of stuff.
Right, or just any tax accountant, specifically somebody who understands startups.
Yes. Okay.
Yeah, thank you so much. And again, we will post this on our Startup UMD YouTube channel. Please reach out to me with any questions or any other suggestions for any future sessions, and I'm thinking we'll have to invite you back because you only scratched the surface of how to get startups going. Thank you so much.
Thank you, everybody.